Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place. Hello and welcome to the first episode of Opto Sessions. Today we're talking to Howard Lindzon, the highly respected founder of seed investment fund Social Leverage. Keep listening to hear more about how the dynamics of the stock market are changing, something we're witnessing today with the current market volatility. This is followed by a breakdown of Howard's famous 8 to 80 strategy, which lists the stocks he'll be buying in bad times, and most importantly, Howard's suggestion on how to keep your sanity whilst working from home. So by means of introduction, I'm Ed Gotham, co-founder of Opto, and this is Howard Lindzon, most notably the co-founder and general partner at Social Leverage, an early-stage seed investment fund with investments in hugely successful companies such as Robinhood and eToro. And on top of this, he's also the founder of Stocktwits, the largest online community of investors and traders. Now, we've seen some huge swings in global equity markets in recent weeks. From listening to your recent podcast, it appears as though you're sort of sitting on your hands at the moment. eToro founder Yoni thinks the worst is yet to come. Is it too risky to buy the dip at the moment? What are your thoughts on that?
I goof around a little bit here, joking, because I feel like the nimble can trade this if they have a clear head. But yeah, for the average investor, the signals were, if you are in the stock market of any capacity, that if you're not 50% in cash, you should really have thought about that already. I mean, it's very hard for most people to get back into the market, so I rarely recommend 100% cash. Everybody's different, but for me, I'm about 50 to 60% in cash by this point, and so I'm because of Stocktwits and Robinhood and my ability to use social networks and all the time on my hand from being in quarantine, I'm trading a little bit.
Okay. And a good follow on from that, I suppose, is just talking about the sort of dynamics of the stock market today. Seem to be sort of changing a lot over recent years, and appears as though there's been a growing interest in investing in the stock market, at least partly driven maybe by low interest rates, but possibly more so by increased accessibility from apps such as Robinhood. What do you think is the cause of the sort of huge volatility spikes we're witnessing today, and also back in December 2018?
I think a lot of individual investors are in the same trade. So, if you think about I'm only going to talk for America at this point, the U.S., because I have no expertise on foreign investing. Although I have invested in eToro, but it's very much a U.S. trading type of model and Forex, just more leverage. But obviously, what we're seeing is as always in every panic, the panics come for the leverage. I think with zero interest rates, this whole idea of earning bonds and stocks kind of being bonds being kind of a hedge to stocks. What happens in a panic is they become correlated, and all this leverage that was in bonds is now getting unwound. I don't know, we don't know how long that will last for, but basically everything is going in the same direction, down. So even though the U.S. Fed lower rates to zero, the treasuries are 1.5%, meaning they've spiked the rates. So that's a panic. Everybody's trying to get to U.S. dollars. The U.S. dollar is spiking. This happens in panics. The danger of panics is, theoretically the system can break and create chaos. But we're closer to a bottom than a top when things break. I mean, you have chaos and dislocation and discomfort and forgetting jobs and human lives. But in the financial markets, you have this great dislocation and unknown. So that's why I think people should have 50% cash by this point. Excuse me, my dog is barking. But on the other side of this comes new trends. We're already talking about food delivery, food, biotech, big data around cures, and we're talking about work from home and teleconferencing and less travel. So, as in every panic, there were trends that were happening. Online education, there were trends that were happening, not maybe not recognizable to regular investors, but in the next 10 years, these are the trends these are the trends you're going to start hearing about. It'll be less about the gig economy. It'll be less about social networks. It'll be less about the smartphone, because those are just a given. Those are just part of the fabric. The next boom will happen in those industries, and this panic and this virus have just pushed those industries into the spotlight. So that's the way I try and think of things. It's not comfortable, and we're just trying to be you have to try and be responsible about that. And so I'm trying to share those messages in these podcasts that I'm doing called Panic with Friends, because they'll be more timely. Like in the next panic 20 years from now or 10 years from now, you'll be able to go back and look at this content, because human behavior is human behavior. And markets do this because of leverage. And they do this because everybody gets comfortable doing the same trade, and in order to increase their returns, they use leverage. And then when these trades unwind, it's the same thing. Airlines blow up, people with leverage blow up. And what I worry about on this panic is, we already had this massive wealth gap. And obviously, this will make it worse. The people that can't afford to lose their jobs are losing their jobs. The executives that created all this leverage in hedge funds will walk away bailed out, and we'll have a further hollowing of the middle class and lower middle class. And that's always the concern. It's not the concern of the executives that the airlines and Boeing and all these bad American companies that put their companies in bad position for this recession, because who would have seen the coronavirus? That's no one would have. But at the same time, the airlines and Boeing and the banks who are going to have to bail out again made it worse. And the hedge funds that are going to need bailing out or walk away from trades are people that were just using leverage on top of old trends to try and beat the market.
So in that way, do you think leverage is a negative thing for markets, or?
Yeah, I mean, it always is. It's just human behavior. It's like the regular person should never use leverage, unless it's for a week, a month, something where they know they have the capital and they're going to be very disciplined about unlevering. What happens in the financial markets is somebody else's money. What's the worst thing that I'm going to happen is lose my job. And if I got to get paid for returns, I'll leverage the trade that I'm in. And if a black swan happens, this is a black swan right now in the markets. If a black swan happens, big deal, walk away. And we're seeing that.
Yep. And in terms of the volatility, do you think that's here to stay? Is it more? It seems to be there's more volatile spikes at the moment than there has been previously.
Well, yeah, we haven't seen there's a great unknown. There's companies that are going to zero revenue from talking about with Eric, one of a trader that I know, and let's just set the exact. It's March 20th today. On February 28th, you had Eric Trump, Donald Trump's son, tweeting, "This is a good time to go 100% in your 401k." So that's 21 days ago. The markets were basically at all-time highs, 5% off all-time highs, maybe 6%. They are now 30% off all-time highs. So there's a lot of irresponsibility and cavalierness about investing right at the top of our leadership. Mr. Eric Trump has gone on to delete that tweet. And it really is bothering, because that was, what was happening. This volatility comes from smartphones, social media, globalization. Personally, I love globalization, right? I mean, the pandemic is definitely the risk. Is America going to drumbeat blame China? For sure. You can already see it in the United States. But how we really, really, one of the trends that I don't want to see, but seems to be underway, is everybody closing down their borders, less travel, more aggravation. This young millennial generation was all about experiences, and if Airbnb and Uber are in trouble, and there's people are worried about virus going in and out. Those are shifts that most people did not see coming.
Yeah.
And those would be very hard shifts culturally for people to deal with. So, for example, Italy, I go to Italy every year. Will I go to Italy this year, this summer? Probably not. And so for the Italians who live off American travel and global travel, this isn't just a tragedy about the economy and people. This is like maybe a 20-year tsunami. We don't know if the virus comes back. We don't know if when it probably does, seeing that it's a flu. So behaviors at those levels change, which is going to increase volatility for a year, 2 years. There's always volatility in different sectors, right? The market had been very calm until 21 days ago. So we went from all-time highs 21 days ago to the highest volatility since 1929 or beyond 1929. So there's nobody that knows what's going to happen next, at least of all me. But I'm trying to do the calls and talk to people and talk it out and think through what will happen next. You're in the panic. There's not much we can do once you've raised a certain amount of cash, and you have to hope the banks work, and you have to hope your community doesn't go crazy and all these other things. But there will be, it may be a year out or 6 months or 18 months, there will be a return to some form of normalcy, because humans are humans and creatures of habit, and they like, connecting with family and friends. It will be interesting to see what that looks like post-corona. And the longer we have this scare, and not just scare, but the longer we watch the fallout from this, we'll just know more. And so the volatility can't go down until we get data that says, it doesn't matter how much money UK or United States or Germany throws at this, or China. I don't think you can calm the markets until the data comes in. And you can't get data, and this is where America's really blown it, you can't get data until you test people.
Yeah.
So it's, I don't know about flattening the curve and yada, 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 but you can't calm people unless they know they have it or they don't.
Mm-hmm.
And we're not doing a good job in the United States of that. Today I linked to, there are now home testing startups that are doing home testing kits. So listen, America and the world here, UK, Germany, it's a common enemy at this point. So I hope everybody can behave and focus on the common enemy, which is just, let's get people tested. Let's help people get through this. And it's, do the blame game. The blame game is going to happen, but hopefully they kick that part down the road. Doesn't seem like the United States, because it's an election year, the volatility should increase, because we know how Fox News and we already know what Trump's doing. He's calling it the China virus. So he's quite predictable, which may help us. We don't know. His predictability may be a good thing at this point. He generally does the wrong thing. So in a crisis, you got to think at some point he's going to continue to do the wrong thing. Testing, his calling it a hoax for a little bit and slowing things down and not getting tests. Americans aren't dumb. They do want to know the truth. I think most people want to know the truth. Even in China, they let, because of the way the government works, so they let people know the truth at some point.
Yep. Let's hope this all ends well in the next sort of like 6 to 12 months, I suppose. Another interesting trend we've seen over the last 20 years is sort of the growth in ETFs. Do you believe like these passive sort of based inflows, which are primarily in ETFs, are sort of distorting the market structure with everyone sort of invested in the same companies? Is that sustainable?
Is it sustainable? I mean, we're seeing there's going to be a lot of discussion post this. I've always been like 90% of people can do Vanguard and the S&P 500. I always thought that was over diversified. So I never liked it. I mean, unfortunately, it's so big that even if you do pick individual stocks like Nike and Google and Tesla, they all get lumped in as ETFs sell. So, that's a really good question. It's the $1 million, financial question is, Americans have been sold since the last crisis, just set and forget. You should go passive. I think the big lie is there is no such thing as passive. Even in the S&P 500, they rebalance every month or every quarter.
Yeah.
So stocks are going in and going out. You just don't see it. So I've never liked it because it leads to a point where few people own all the stocks, and therefore, why do I want to own 500? Why do I want to own the 500th best company in the United States? Why not try and own the best 50? Like, is there really a difference between owning 50 stocks and 500 or 30 stocks and 500? So I've always felt like investing is a privilege, and just to blindly put money in an index has never made sense to me. But in a market that's down 30 or 40%, I think the best thing people can do if they want to invest is use like an index. I recommend always over the S&P 500 is the NASDAQ 100, which is more new economy. I don't want to own energy. I don't want to own banks. I don't want to own commodities. And so if I own the NASDAQ 100, I own 100 of biotech, healthcare, software, technology companies. And yeah, it'll be more volatile, but the next 30 years, I'd like to not have to own industries that I could care less about, airlines.
So you're looking for growth.
Well, I'm okay with my stock market money to go down, because I know that at some point it'll be down 40%. Like, it just is. That's just how the markets work. I don't know when it'll happen, but it just happens. And I don't know how long it takes for that to happen. It just happens. This is the fastest it's ever happened. But I do know, if you bet on America, since 1700s, let's say, when they could trade or invest, and maybe it was 2 companies or 100 companies or 30 companies, that the direction has been upwards. It doesn't matter who the president's been and how bad the leverage has been and how bad the crash is and how bad the depression is. We're 30% to zero right now. So, is there another 50% down? Sure. I mean, at this point, we've survived 30. And if people have cash, it'd be crazy not to start investing in the future today. It'll be painful, but you continue. If I can invest down 30% and continue to invest to down 60%, I know that over 10 years that those will be good investments.
Yeah.
So I try and think of the bright side. Okay, you can't do anything. You can't look back at the last 21 days anymore. I mean, we will forever, but as an investor, it's not going to do you any good. I think now you have to just reassess, take a look at what risk you're willing to take, understand kind of the historical 10 to 20 year time horizon, and then just, turn off the TV for 60 days, take care of yourself and your family. And this is a great opportunity.
Okay, great. Yeah, no, I completely agree. And another thing that's sort of interesting at the moment is that interest rates for many countries are at near or record lows. Longer term, with a lack of options to potentially grow your capital in other ways, does this scenario result in more demand, do you think, and capital inflows into stocks, driving up prices long term? Or
yes, I mean, mathematically and textbook wise, yes, because I think the biggest change is going to come in corporate structure, right? I don't want to get too geeky, but how many times are we going to bail out the airlines in an era of technology? How many times are we going to bail out banks and Boeing and bad behavior? And I think we now have the technology and blockchain and tokenization, which was a bubble in itself and probably still 10 years ahead of the curve. But at some point, we're going to say, listen, Boeing or airlines, here's how it's going to work. You're going to make $1 million a year, not $200 million a year. Investors are going to invest in different parts of the airline. There is no airline there's not going to be an airline stock. There's going to be people that bet on the revenue. There's going to be people that bet on the expenses. There's going to be people that take the debt. And so the company will focus on running the business, not on increasing the shareholder price for the sake of the shareholder price. So that's the future. Like, that's like 50 years, 20 years from now, because it makes no sense. Like the way the system's structured right now is terrible. And human, it works good enough, but I can see a world where for certain companies that should be state run or government run, that we should cap the salaries of the executives. I mean, I'm sure we can find a good executive to run Boeing for $2 million a year, not $300 million a year, right?
Yeah.
It's you and I don't qualify, but there's hundreds of qualified people that would take $2 million a year.
Yep.
Okay, so that's just common sense. The people need to speak up about this stuff, and if not, eventually technology will take us there, and people will just avoid buying those companies unless they tokenize it, and you can, get some good behavior. But with zero interest rates, bonds make no sense to me. Why am I going to invest in a European negative interest bond? Like, who could advise someone to do that? Now, I understand if you're a billionaire and your money, and you're worried about your money, and so you have to leave it at a bank. I can imagine you just being happy to get 99 cents, instead of 100 cents back on your dollar every year, and you pay 1 cent a year just for the privilege of holding your money. So at that level, I get zero interest rates. I totally get it. I didn't get it until recently, but I get it. That's a tax on the rich, theoretically, that the banks can take. For everything else, I think I don't understand it. I don't understand any of it. I think I never believed in bonds. I believe that people should take risk and manage that risk, and they should invest in startups themselves, their education, their own business, learning how to invest, use Robinhood and Stocktwits and all these companies to learn how to take real risk. I'm not against bonds. I don't understand how any normal person wants to earn 1% to 5% on their money. I don't get it. Now, for people who don't want to take 40% risk and see their portfolio open 40% down, I get it. But I would rather than just leave it in cash than try and take risk.
Sure.
So that's what zero interest rates will wreak on the markets.
Okay.
They'll force better decisions at some level. If people want to be stupid and put their money in 0% products, their hard-earned money, I don't get it. I'd rather figure out creative ways to invest it.
Yeah. And if a scenario such as a recession occurs, what do you think the impact?
Well, we're in a recession. There's no scenario. I mean, my son. Let's do an example. My son, who just dropped out of school, is a good kid, just didn't like school, saving us a lot of money. But as parents, we want our kids to go to college here. He just wanted to work. Guess what? He has 2 jobs. He's out of work right now because the restaurants are closed. So we're in a recession. Like, if we have to support him, he has no job. He wants to work. He can't work. And multiply that by 20 to 50 million Americans. Yeah. So who cares about the numbers? We literally went into a recession a month ago. And by the way, again, these are just terms. If you worked in the energy sector, you've been in a recession for 3 years.
Yeah.
Right. So there's like individual recessions, and then there's, country recessions. Italy's in a depression.
Yeah. And with the with less capacity to use like monetary policy to stabilize and kickstart economies because of the low interest rates, how can the Fed sort of help support the economy in this sort of, if we are, in this sort of recession now?
I mean, it's over my pay grade. We're talking about $3 trillion. I mean, I don't even know what that looks like. There's no context. Kids on TikTok are doing a better job of explaining it than CNBC in the United States. So I recommend people just go to TikTok and search $3 trillion. No, I mean, like, it's funny, but that's truly what's happening. Kids are trying to explain it with matches and rice. And, they're doing a better job on social media than they are on regular media. So, I just don't understand the numbers. I don't trust our government. I think smart people are looking towards their community now and doing local things. And guess why we're doing it? Now we have the event of why we're doing it. Your local matters. In Italy, local always mattered, and now it's going to matter more than ever. So same thing in the States, same thing in China. The media will be playing the blame game, and the media will trying to, but the 99% of people are just trying to make it month to month. My advice is, don't expect any help. You've got to immerse yourself in the new economy, and build your network and find a new skill.
So yeah, this is almost instigated
Yeah,
full-on
it was
change
coming.
in a
Like, come
way.
on, let's be honest. I'm just talking U.S. again, right? Like, I
Yeah.
traveled a lot to Europe, and it's my favorite place to travel to, and I know what's going on in the Netherlands, in Norway and the Netherlands and the UK. I know by foot travel what walking the streets. I have my own intuitions and my friends in Italy, in Greece, and so I have my intuitions. But I'm an American. I'm a Canadian, but I'm an American. So I'm very focused on staying alive and thriving in America. And it's been obvious that if you're, and this will only prove it more, thank God I'm not in the right. Now, we're all going to lose money. So I'm not perfect, and everybody's going to lose 20 to 40% of their money. So for people that are like pissed, trust me, everybody's lost 20, full stop. This month, 21 days, everyone in the world is 20 to 40% poor. Now, there's 1% that got richer, which I talk about the wealth transfer, the people that knew what was coming, the people that positioned themselves. Well, that's 1%, right? Even Warren Buffett's going to be down 20 to 40%. It'll be much easier for Warren Buffett to be up back to break even faster than 99% of the other people.
He's got cash to invest.
What's that?
He's got cash to invest. Is that?
He has cash to invest. He's done this before. Someone walks in with the best deals. His door, he sees all the best deals. We don't. You, me, everybody listening does not see the best deals. So all we can do is just try and figure out where the world is heading and the skills that are necessary to thrive in the new world. Is that going to be going to college? No. That is just a way. There's nobody that... Listen, I loved college 40 years ago. Is where I socialized. We didn't have a smartphone. That was where you built your network. That is where you hustled to decide if you want to go to graduate school. There is no real reason in America, other than maybe a doctor or very specialized things. And maybe those people didn't go to college. They go to special colleges for people to go to get an undergrad degree, a general undergrad degree. That is at the low end, 70 grand. And at the high end, 300 grand. I can't do the exchange right now in quid, but it's a lot of money.
Yeah.
So that's a broken system. This is a tipping point towards education. Engineers have been dropping out for years. I think other people will drop out. And so why go through this to have debt? So I think that's interesting to me, and it's just up to individuals to position themselves better.
Sure. I completely agree with that as well. And if we segue now a bit into your investing strategy, we just wanted to talk a little bit about your 8 to 80 framework.
Terrible branding, but I'll explain. I'm not a good marketer. The 8 to 80 is just, it's really now infant to invalid. But basically, there are certain companies and brands that are timeless that infants use and 90-year-olds use. Now that's going to change post this trend. I can give a couple examples after, but Nike, Starbucks, Lululemon, Google, Amazon, Apple. I'm not going to use any European companies right now. Maybe Tencent out of China, which is WeChat. Maybe Alibaba. But there's 50 what I call 8 to 80 brands around the world where if they drop 50%, this is why I don't understand why people index. If they drop 50%, and a lot of them have, Starbucks is down 50%, Lululemon is down 50%, Google's down 30%. I may even throw Facebook in there now, down 40%. There are 50 or so brands that you should be so excited that they're down 30 to 50%. Why would you want them to be at all-time highs? Like, why pay retail for something that's now on wholesale? Now, at some level, I'm rooting for them to be down 70%. It's scary, but at the same time, is Starbucks going to go away? Yes. Will habits change? For sure, but habits are going to be worse. It's worse for Starbucks competitors, the corner coffee shop that wanted to just have a local experience. So who's going to bounce back it's no different than Warren Buffett. Who's going to bounce back the fastest? wants this, and Starbucks, because they can spend the money on drive-through and curbside delivery. They can spend the money on their employees and overpay them, but the corner shop is a goner. So, while everybody's freaking out, there's a fire sale. Starbucks hit 50 days ago. So you look for these brands that are timeless, that an 8-year-old uses or an 80-year-old uses, and preferably companies that make money. So, you could throw Tesla in there, you could throw a lot of companies in there, but they don't necessarily make money. So they're much more riskier. And so I prefer companies that have profits.
Sure.
And so my 8 to 80, this is when I'm get excited.
So this is the 80 time then?
Yes. So Visa today, these are down 40%. Could it be down 70%? I hope. It won't be pleasant, but why would I invest in something other than that when we're down 50%? I don't need to look at a biotech company. I mean, I don't need to do extra work when the whole market's down 50%.
And what sort of time periods are you looking at with these investments? You mentioned before there's some stocks you never sell.
Yeah, I mean, you sell pieces of them, like I was selling them on the way up, but everybody's different. I mean, like I said, I'm not looking to sell, at some point I own those companies. So it hasn't been pleasant. That's the 50% of what I have is in stocks that are down 30%, 40%. But I can't catch 500% if I'm worried about 30%.
Yeah. And do you decide to allocate sort of equally in this portfolio, or is it?
No, I mean, everybody's different. I have no scientific method. That's why, there's no one strategy, but, generally as much equally as possible. And then every quarter, maybe you look at it and go, I have too much in Apple. So you'd sell a little Apple and put it in one of your 8 to 80 companies that is down 20%. It just depends. But it's like gardening, right? The English like to garden. You go in your garden and you got to make some decisions.
Yeah.
But it shouldn't overcomplicate things. You pick companies that you use every day, or that you think, I focus on America, and so should the rest of the world, because 300 million people really spend a lot of money here, and that's where all the trends happen culturally. So, as bad as our systems are, the financial markets are the least rigged in the United States, or most liquid, theoretically, most of the time. So I focus on the U.S. markets. So very myopic.
Yeah. Yeah, I quite like this. It's quite a simplistic view looking at things, but very powerful.
Well, I don't know why it needs to be complicated. I get why.
I completely, people tend to overcomplicate things, and I think this is a very good way of looking at it without incorporating too much analysis and
I mean, if I was going to teach somebody English, if someone's going to learn English, they don't go into sentence structure right away and tense. They just learn a few words. And to me, the first few words are, what are the products that you use, that of in your house that when an infant or what are the products that an 8-year-old and an 80-year-old use, and just narrow it down that way. I've done that for people. And most people go, Now, when you buy them is hard. When you sell them is hard. But I don't want to garden. But if I was going to garden, I realize that it's work. I'm going to have to go out and trim the hedges every month, or, prune. It's just not going to happen automatically. So you have to commit to it. I think if you're not willing to commit to it, that's okay. But I wouldn't just hand your money over to somebody even if you're going to trust somebody to do it, you should understand the basics.
Yep. And when would you consider removing a stock from this list, or reducing
that's a
your
good
exposure?
question. That's a great question, because I do it all the time. I'm just wrong all the time. I keep track of it for people on my blog, howardlindzon.com. But what have I removed? I've removed Facebook before. I don't really love the company, but it's on the list right now. I've removed
Tesla, I think you mentioned,
I've removed Tesla because it just doesn't make a profit. Although I'm considered, as soon as they get through this, I'll probably go back on my list. I'm thinking of a couple more healthcare stocks now that healthcare is going to be more a focus. So I'm constantly thinking about that.
And you mentioned this sort of change that's happening at the moment has changed the sort of companies you're looking at in your 8 to 80. Is there a few that might enter that list now that you wouldn't have thought of before? Or
Yeah, I'm looking, for example, there's I think medical devices and healthcare, and I'm
yeah,
not
okay,
in those spaces, so I'm studying should I add an ETF to that cocktail. There's a medical devices ETF, IHI, Ida Harry, Idaho, that's down 30%, but so it's a basket of medical device companies. So I'm trying to get my head around that. I think the aging population, things like that I'm thinking through. But at some point, maybe Nike and Google are good enough to
yeah.
cover that. So you can overthink it too.
And you mentioned whilst you have like some more these sort of strategic longer term investments, you also have you take advantage of shorter term opportunities as well. Can you tell us about your little strategy and how it differs from your longer term investments? What you're looking for? How do you find opportunities?
Obviously I started Stocktwits. I've been investing in fintech for 20 years. So I have a good flow of information. This week, even, because I'm locked in my house and because I'm talking to really smart people and everybody else is locked in their house and everybody has time to chat. I'm focused on the markets and I've been trading a little bit, but I don't really, people can follow me, but I try not to. It's a very personal thing. So I try not to get people in trouble, because people will just, cherry pick which things which I like. So I really, for me, it's when things get this crazy, I try and think even longer term. So, like I said, travel, health, fintech, how are those industries going to be affected?
Mm-hmm.
And, for me, I think the markets, it's like learning English or Chinese. I mean, it's a language, and I think it's going to become more important to the younger generation as they try and understand this. And with crypto and tokenization and decentralization and possibility of closed borders, financial markets will become more important.
Yeah.
So I'm actually focused more on the long term right now. I'm trying to try and focus all my phone calls and attention on what's going to happen in 6 months, not tomorrow, because it's going to be the news is going to be terrible for 6 months.
Yeah, no, I agree. Yeah, and talking about longer term opportunities, tech has obviously been a big one for the last sort of 5 years or so. You've touched on some themes, but what do you think sort of might be interesting for global markets over the next sort of 5 to 10 years? You've mentioned medical devices.
I think, obviously in healthcare, we're going to have to speed up. With the coronavirus, now we're hoping that there's a vaccine 12 to 18 months, and we're hoping that the National Guard can deliver testing kits. But I think people can't wait that long. So people are using the internet to find and do their own testing,
Mm-hmm.
damn the risk. So I think people are going to go around the government if the governments aren't prepared, and this will be like a first big while. So there's that there, but it's too complicated for me. We're focused on helping. We invest $700,000 to $1 million in startup companies that have one to 5 people, generally around financial services or around enterprise software. So we're betting on people. And people that have a vision for the future that has been bugging them for 5 or 10 years. They have domain experience. They may have worked at Uber or at Robinhood or at eTrade or at Nike and said, this is the future. I can't do it within these companies. And, they have a reputation, domain experience, and they find us. And we invest a first check to help them carry out that vision. For us, it's financial services and enterprise software.
Yeah, and so social leverage is obviously very active in fintech. And you must have learned a huge amount over the years about what's interesting to invest in at this early stage. Uh-huh. So, what sort of in these ideas? What ideas make you interest you? What do you look for in that?
Well, I think it's the same thing, right? We're all making bets. There is a group of people that we're betting on passive investing. There's a lot of money invested in this passive investing idea that I never really understood or agreed with. And so there was a lot of robo advisors and neobanks. They sprung up in Europe and the United States, where people will just blindly hand over their money, and they'll check their phone once a month, et cetera, and continue to deposit money. I think the wake up call will be, hey, they opened up their phone and they're down 30% and they don't have anybody to call. So, what's going to happen is people are going to decide that they want to have a person that they can talk to again. Mm-hmm. And so, that was my bet 10 years ago and 20 years ago. It continues to be my bet that, building up trust and running a lean financial service business, giving people choice and actually helping them, truly learn how to do this, a la Robinhood and eToro, are going to be even more important. Mm-hmm. So I don't think that trend stops. I do think more international will get involved, and they, while always a little bit different, I think everybody wants choice, and everybody doesn't want to be treated like a dumb person, and everybody can learn this stuff. So I think that same trend will continue, education and do-it-yourself investing. And then in enterprise software, it's, as work from home continues, there's going to be hundreds of companies, thousands of companies that spring up to speed that process and to make work from home and remote work even better. And then as companies have to deal with these remote work, selling products to companies that help them manage remote work, obviously will be important. Accounting, human resources, cost controls, surveillance, video, there's all these things.
Yep. And have you?
Just the big trend. You got to narrow it down to go, okay, if work from home is going to happen for real, what are the 10 things that work from home matter?
Yeah, for sure. Definitely conference calls. It's become very important very quickly.
Yeah, you didn't know what a Zoom was until now, and now Zoom.
And Zoom's very top. Yeah, well, I only know it because of how successful it's been on the stock market since it IPO'd.
And now everybody knows it. Meaning, even high school kids that were are supposed to know this stuff before the adults were like, "What's Zoom?" And now they're all Zooming. Usually, we learn from the teens, and this time it's the other way around.
Yeah. And have you learned anything from your experience in VC that's helped improve the way you invest in the public markets? Or
yeah, I think they're very connected, right? I think for me, it's helped the fact that I can't panic, right? If you're investing in 20 companies and none of them can sell their stock and none of them are public, well, then why worry about it? Help the companies succeed. So I think the fact that, and this is the same thing with 8 to 80 portfolio, if you can't help Robinhood, if I wanted to sell my Robinhood position or eToro position tomorrow, I couldn't. I would imagine it would be worth 30% to 50% less than it was yesterday. But in the end, my house, I can't sell it tomorrow. It's not liquid. And so I think that's what's helped me build the 8 to 80 strategy, meaning, I know Nike's down 40%, but if I like the company, if I like Robinhood and Robinhood told me tomorrow I could buy more shares down 50%, I probably would.
Yeah.
So I try and think, so even better if it's a public company and a brand that's been around for 40 years.
Yeah.
I'd rather buy a brand that's down 40% than a small company that's down 40%.
And
I think the markets are the same lessons that you can apply.
Yeah. But there is an investment you made recently. Is it Sockfi, which could potentially?
Wouters lives in London, lives on a plane, but lives in London, and the engineers are in Amsterdam, but it's a U.S. company. Sockfi is trying to help. We call it pre-wealth. I think there's this whole next generation in the United States for now, and soon to be Europe and the rest of the world, called pre-wealth, meaning they start a company, it's quite successful, the public markets are not for them, and they need to, they have employees, those employees need some liquidity to buy their first home or whatever. It's a very successful company. Let's call it Uber. And, 5 years in, your stock is vested. You are making $200,000 a year as an engineer, but you have millions of dollars in stock that you can't sell. So you can't buy a house. You can't send your kids to college because you have a good salary, but you have no money. And so SecFi has built a security, a product that helps executives and engineers and employees at later stage private companies use their options and create a non-recourse loan for the employees to get some money out of the stock. And it's a win-win-win because the company needs those employees to stay now. And it takes, it's a peace of mind for the employee. It's peace of mind for the employer because the employee, won't quit and they won't have to replace that person. And the fund or the hedge fund, or right now it's hedge funds that lends the money, is they're sophisticated investors and they understand the risk. So it's kind of a three-way transaction. And for the employee that borrows the money, they can't lose more. They're not on the hook for that money, right? They put up their stock, and the stock may go to zero, and they may lose their stock, but at least they've got the loan, and no one can come after them for the loan, and they can go and buy their home or diversify.
Yeah.
So it's a very unique product that kind of turns the private markets into more of a public market.
That's very interesting. Yeah.
Yeah. It's very complicated at the beginning, but it'll slowly become more normal.
There's another company. I was recently in New York as well, and there's another company that you've invested in, Rally Road. I went to their store there.
Fantastic. Right?
Great company as well. Yeah, really, really interesting.
Very edge case scenario in the sense that all Rally Road is turning collectibles. They whether it's Babe Ruth rookie card or Mickey Mantle or Muhammad Ali pair of shoes that have just intrinsic value. Excuse me. That and they do through the SEC. They do an IPO, let's say at the $80,000 Mickey Mantle card, and then people can buy a piece of that card. So it's very esoteric and very American right now. It seems silly at some level in a recession, but they've really created a beautiful experience where young kids can own, put $200, $300, $400 to work in assets, cars, special cars that have a history of appreciating over time.
Yeah.
And
not available in the UK yet. I asked them if I could
not available. Okay. And at some levels, still very early stage, but very unique approach to helping people learn about investing. In 10 years, they may be just doing regular stock transactions as well and be a bank, but they're starting out by doing this unique asset, kind of like SecFi is doing.
Yeah, no, but it's very interesting. Just to finish, I've got some quickfire questions. Not looking for like a huge response to them. It's just like whatever comes to mind. If you don't mind, I've got, I think there's 6 or 7 just to finish. So top 3 mistakes investors make?
The number one is they over diversify. If most people end up with too many things in their portfolio, including wealthy people. But if you're just beginning, the number one mistake is to over diversify. You should be focused on investing in yourself or the 1 or 2 best people that are doing something. I tell young people here just to climb aboard a rocket ship, meaning sometimes you don't have to start your own company, but it may be TikTok or it may be Facebook. Figure out a way how to get in the ground floor and get in that company, and just close your eyes and work really hard. That's a very American thing because it's possible here. So why invest in the stock market if you love a company? Go work for it and take whatever job you can get. So that's kind of the number one tip I give to people. They're over diversifying. The second thing is they have to just get started. I don't think you can learn about investing unless from watching it on TV. I think there's
skin in the game.
Yeah, you have to, whether it's 1 share or $50, you should see how you'll react when you lose money, because you're going to lose money. So the faster you open an account and put some money to work, you'll understand your behavior better, because maybe you have more appetite for risk than you understood, or maybe you're actually going to be good at this. The other thing is, pay yourself first. There's a couple apps in the United States for young people, kind of tricks them into saving money. Acorns, for example, it's like a old thing. Hey, pay yourself first. Make $2,000 a month or $5,000 a month. Take 10% of that and just put it in an ETF or Nike or Google, right?
Mm-hmm.
Well, in the old days, 10 years ago, that didn't make sense to you, right? You're going to deposit your money in the bank, and you're going to theoretically pay. You're going to set up a separate, But now with the app like Acorns, it automatically takes $5 a week and puts it into you don't have to do anything. And so it just quietly does that for you. And whether you can afford it or not, at least it's stealing from yourself in order to invest.
Yeah.
I think that's like a trick that is a software trick. That's a really smart thing that everybody should do.
Yeah. No, I completely agree.
And then, pay for mentorship, right? Like if you really are serious about investing, go on Stocktwits, or, open an account, go follow people like me and see who else we're interacting with, and find someone who charges even, but at least you can get some mentorship.
And so that sort of segues into our next question, which is, who do you go for market insights or mentorship?
This is all on my Panic with Friends. I kind of think long term. So all the people that I've had on my show, just venture capitalists and retired investors that are sharing for free on Stocktwits and Twitter and their blogs. So if you go to my blog, you can get a list of all those people. But so it's just a group of people that I generally chat to, and now I'm doing it on my podcast that are very calm and successful and have been through cycles before and think bigger picture. And I try and keep it pretty simple there. Not that many people.
Yeah. And what's the most memorable moment from your career in finance?
There's so many. I mean, this would be just because of the virus and the global nature of it, I would say this one, because it's happening right now, and it's a historic move in volatility and panic. So I think this will be talked about for generations.
Great.
The wait was surreal, but it just, everybody was, I was at a different age. I think this one is like really interesting to watch because my kids are in their 20s, and we've got social networks to talk to people in Italy, and we have friends that have lived in China, and so it feels you're more connected to the whole thing.
Yeah. And a top tip for your younger self?
Buy Apple.
Okay.
Yeah,
that would work. Yeah. Disney, Apple, Netflix, who are you backing in the streaming wars and why?
All of them. I think Disney is the least interesting not because of their product, but because they have theme parks. You can't buy one with it. This goes to tokenization. Mm-hmm. Great if you could just buy Disney's subscription business and not their theme parks, because people, how fast is the whole world going to clog back up a theme park after this? So I think I would say Apple still.
Sure.
But Netflix close second, because you're just buying one business, which is subscription around content. Sure. Is it overvalued or undervalued? That's a different question, but very focused company.
And finally, any tips for how we can stop going insane whilst working from home for a long period of time?
Move somewhere that has good weather.
Move somewhere that's got good weather. All the borders are shut.
That's, you guys weren't thinking that you should have interviewed me last year.
Yeah. I think we tried to. Okay. We're too busy, Howard.
Yeah. Well, that helps. But yeah, I think warmer weather, I think that just makes sense. It's not for everybody, but obviously when it's nice outside, it makes it easier to survive these things.
Yeah. No, definitely. Well, that's the end. And thank you very much for allowing us to interview, Howard. Really appreciate the time that you've given us. I don't want to take up too much of your time today, but I highly recommend everyone signs up to Howard's daily blog, which provides some really great insight on life and investing. That's at howardlindzon.com, I believe.
Yes, sir.
Yeah. Is there anything else you'd like to share before you go, Howard?
People want to invest. I think Robinhood is now in the UK, so you can just download the app in the store. Stocktwits, it's easy to find me on Stocktwits if you have investing questions. It's like Twitter but for stocks, so people can sign up and follow me there. But yeah, if they come to my blog, it's a daily free blog about investing, so they can sign up for free. And every morning at 9 a.m., I deliver some kind of morsel about investing in stocks and private companies.
Brilliant. Thanks very much. It's been brilliant to talk to you, Howard. You're a big fan of mine. I've followed you for quite a long time, eight or so years or something. So it's been a good opportunity.
I appreciate the support, and I'm excited to listen to this in a week or so.
Excellent. All right, Howard. Have a good day. Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.